$84 trillion is set to change hands over the next 20 years. Whether you're passing it down or inheriting it, the decisions you make today will shape your family's financial future for generations. Welcome to the Great Wealth Transfer, where David Pulcini, CFP, guides you through the strategies, insights, and pitfalls of navigating one of the largest financial shifts in history. What you don't know could redefine your legacy.
Picture this. Picture someone you know that has been successful, right? They seem to have done everything right or close to it. Not everybody can do everything right, but they seem to just have nailed everything. This could be a parent, an in-law, an aunt or an uncle or a cousin or somebody that you know. This person has it all together. They are sought out by others for advice. They're mentors, they're leaders, and in many cases have left a positive mark on the world, right? This person could be you, by the way, but let's say it's someone else and someone that you know. So now, after years of looking up to these people, thinking that they had it all together, thinking that this person is always a step ahead and they must have everything of their own buttoned up and taken care of, right? Then they pass away and their loved ones realize that things were not planned for correctly or at all. They leave their families scrambling, hunting down accounts, documents, beneficiaries that have not been updated. The family doesn't even know where all of the bank accounts are, where the mortgages on the investment properties are held, or if this person even had life insurance. What does that family or you think of that person now? The person that had it all together for 30 to 60 years that actually did not, okay? They have actually created a mess, and that is the lasting memory of the person that these people always thought was a step ahead. So let's end that. If you don't have a plan for your estate, and I will add an updated plan, and you pass away, everything you've built could be tied up in courts. It could be eroded and taken by taxes, or it could be possibly the worst is the family conflict that tears loved ones apart, right? That's scary. And it doesn't have to be that way. So in today's episode of The Great Wealth Transfer, we're diving into the actionable steps that you can take to craft an estate plan that fits you, okay? We're going to go over how to ensure that your money and your things are passed down properly and effectively, how to align your beneficiary designations with your plan, which really is just making sure that the people that you want to get your money and your things actually get them, and even what to do with your personal belongings that often go overlooked, okay? So stick with me. By the end of this, you'll have a roadmap to protect your legacy and avoid a number of costly mistakes. We're going to go over wills, trusts, tax strategies. We're going to talk about those beneficiaries, how to pass on bank accounts, your personal belongings, avoiding family disputes, and all of that stuff. So let's start with this because I've said it a few times already. What is an estate? Many times people hear that word and they think that's only for really wealthy people, or estates are only for rich people. That's just not true. Your estate is everything that you own, your financial accounts, real estate, personal belongings, and even it could be your digital assets like online accounts, okay? It's not just about money. It's about everything that you leave behind that has any value at all. And it could be a sentimental heirloom or obviously a substantial investment portfolio. And that's what most people think of when they hear estate. So an estate can also include liabilities like outstanding debts or mortgages. When we talk about estate planning, we're focusing on how do we manage that and distribute that and protect those assets to ensure that our clients, or hopefully in this case, the listeners' wishes are carried out efficiently. Estate planning, again, is not just for the wealthy. Everybody has an estate, and without a plan, the distribution of your assets will follow state laws, which may not align with your intentions, right? I'm sure the state you live in is not thinking the same things that you are. And that's why we're taking the time when we meet with clients to craft a thoughtful estate plan. It's so important. So let me give you guys one example of what happens when someone passes away without a proper estate plan. or without a plan at all, and the state decides what to do with your money. So let's talk about Jane. This is a real story. I'm changing names, obviously, but Jane was a widowed mother of 2 grown children, Emily, and we'll call Emily and Brian. And she had always intended for her estate to be split equally amongst her kids, right? Jane wants to pass it on to her 2 kids, Emily and Brian. She talked about it frequently and even promised Emily that Emily could keep the family home. And obviously, you guys know this. If you've had a long time home, it's a place full of memories and all of your things. But Jane never created a will or a trust, basically just believing her intentions were clear and that the process would naturally unfold the way that she wanted. When Jane passed away suddenly, her estate, which consists of the family home, like I said, she had a small investment account and some personal belongings, entered into, it's called intestate succession, which is basically the process where the state determines how assets are distributed when there is no will. Okay, so here's what happened when the state decided. The state law dictated that Jane's estate had to be split equally among Emily and Brian. Okay, however, Emily couldn't simply inherit the family home because it was not legally designated to her. The home had to be appraised and its value included in the full estate of all of her stuff, okay? So what happens is, in this case, Brian lived out of state and had no attachment to the home and wanted his share of the inheritance in cash. So there was a forced sale of the home, and since the estate's liquid assets were not enough to cover Brian's half, that's why the home had to be sold to provide him with his portion of the inheritance, despite Emily's desire to keep it, right? The other thing is, when it goes into probate and there's no plan in place, the estate was tied up for over a year, which is a legal battle, we'll call it, and that just racks up the fees. And you guys know this. There's administrative fees, legal fees, the time, and it took a significant portion of the overall value of the home and Jane's belongings. So Jane's personal belongings included, we'll call them heirlooms again, jewelry, sentimental items, were not specifically designated for anybody. She had no list. So this led to disagreements between Emily and Brian, with some items ultimately being sold because they couldn't agree on who should keep them, okay? By the time the process was done and complete, the estate's value had diminished and because of those fees and the forced sale of the house. Emily lost the house that she hoped to keep, and Emily and Brian's relationship was strained because of the conflicts around the whole process. So we want to avoid all of that. And honestly, it could have been easily avoided. And we're going to talk about how to do that today. So as you guys listen today, think about the full picture of your own estate and how you want it to be taken care of. Okay, so let's start with the basics: wills and trusts. And I get a lot of questions about this. What's the difference and why do we need them? I'm going to talk about it right now. A will and a trust is the foundation, but the real foundation, the easiest way to get started, is the foundation of any estate plan is the will. And a will outlines how you want your assets distributed after your death, your stuff, okay? So it's crucial to name an executor. And you hear there's a lot of jargon in here, but an executor is somebody that you put in charge that you would trust to carry out your wishes, okay? Without a will, we already talked about this, the state would determine how your assets are distributed, again, which probably doesn't align with what you want. So we want to list everything in the will as much as possible and then update it, which we're going to talk about in a little bit. But a trust, on the other hand, I would say is a more powerful tool for transferring your assets. There are several types of trust, but we'll just talk about a living trust, for example, allows you to transfer property while avoiding probate, which again is lengthy and costly. So trust can also provide more control over how and when your beneficiaries receive assets. So for example, you could set up a trust to distribute funds to whomever you'd like at specific milestones. So if you wanted to go to your kids, you could set it up when your child, maybe when they turn 30, or maybe when they graduate college. You get to pick the rules, okay? So one of the things that we run into is a lot of times if folks name minor beneficiaries on their insurance policies or their assets, what if your children get money when they turn 15? It's typically put into an account. It may be managed for them, but the day they turn 18, they're going to get a large check. So if you have a $500,000 life insurance policy and you have one child, and that child gets a $500,000 tax-free check at age 18, do we think that's good? Usually the answer is no, okay? Let me back up here. I did say the word probate 3 or 4 times already. So if you don't know what that is, again, we talked about this a little bit, but it is the legal process through which a deceased person's estate is settled and distributed according to their will. Most times when people hear probate, they immediately think, okay, there is no will. Probate is just the process that splits the stuff up. So if there's a will, probate is easy. If there is no will, we have to go according to state laws, which makes it more difficult typically. So what this process does is it ensures that debts are paid, assets are distributed, and the legal transfer of ownership is completed. Okay. So I'm going to give you a call to action on this part. As we cover these things, keep in mind that it's essential to seek legal advice. I'm not an attorney, but an attorney can help you choose the right trust or will and structure it, obviously, according to what complies with you and whatever state you're listening to this in. And we want to make sure we get that right. So I'll ask this. How many of you have thought, I really need to get that done? How many, or we need to get that updated? We hear this all the time. Yeah, that's one of those things that I know we need to get taken care of. I know we need to update it. Here's your action item right now. Write an email to your attorney. If you have an attorney, send an email right now that just says, I need to update my will, or I'd like to talk to you about a will. That's it. Okay. If you don't have an attorney, email us at info@sixpointfp.com. We'll put that in the show notes, or you can go on our website to see that. It's info@sixpointfp.com, and we'll help you find an attorney. Again, we don't do this, but we can point you in the right direction. I want to give you guys the next smallest action item, right? And that is literally just send an email. Get the process started and get rid of that nagging doubt that you have. Okay. Next, with estate planning, run into this all the time. Beneficiary coordination. And what does that mean? It's one of the most often overlooked aspects of estate planning is coordinating your beneficiaries across different accounts and documents. So I want to be very clear with this. Your will does not override the beneficiary designations on your accounts. So your retirement plans, your life insurance, your investment accounts. If the beneficiary listed on these accounts, so say your IRA, is outdated or incorrect, those designations, that person on there takes precedent over your will. So if you go do your will and you think that you're all set and you don't update your accounts, you're not all set. You need to update your accounts as well. My most scary example is, and I've run into this a few times, if your ex-spouse is still listed as a beneficiary in your 401k, they will receive the money, even if your will states otherwise. Okay? So the action item here, take some time to review your accounts and ensure your beneficiary designations match your overall plan. As advisors, we have to coordinate these all the time with somebody's will. So we will typically, as financial advisors, work with the attorney, see who's listed, make sure the accounts are updated, and we'll even send that back to the attorney. So meeting with an advisor or your attorney with all of your statements can get this straightened out for you, or at least confirm that it's accurate, right? So one that I've recently seen from a client is that a wealthy client did not update their beneficiaries after their adult son was divorced. Okay, so clients had a son, did not update their beneficiaries. The language in the will and the beneficiary designation would leave money to their minor grandchildren, right? By proxy. And that could then in turn technically be managed by their ex-daughter-in-law. And very few of you want an ex-in-law to be left in charge of any part of your assets, right? So make sure we get that taken care of. Let's skip ahead to bank accounts right now. There are several ways to pass these on efficiently. What I will say is, in many cases, there's different designations, and I don't want to go through all of this right now, but you can go to the bank and make sure that if you pass away, it could be payable on death, it could be joint ownership, it could be included in a trust. We want to make sure that your bank accounts are labeled properly. Okay, so the action item with bank accounts, check with your bank about adding payable on death, or consider discussing trusts with your attorney for that more comprehensive solution. Okay. And let's not forget about this. This is the one that's skipped a lot. It's the personal belongings, your stuff, right? Where does all your stuff go? So estate planning is not just about bank accounts and investments. It's about all of those personal belongings, furniture, jewelry, clothes, sentimental items. And that is often the source of most of the family conflict. Okay. So the tips for this, and any good attorney will tell you, is to create a list or a memorandum of personal property. So many states will allow you to create a separate document listing specific items and their intended recipients. So this can be referenced in the will, and that would make it legally binding. So you can literally list out thing by thing that you want to go to somebody, okay? And another thing you could do is just discuss your wishes. You can have open conversations with your family about who should receive what. It could help prevent misunderstandings. However, I would still, based on what I've already talked about, get that listed in a will, because we could talk about it today, but when stuff happens and it comes down to it, we want to make sure that the disputes are minimal, right? And for high value items, such as artwork, I actually literally ran into that today, or collectibles, I would consider naming these explicitly in your estate planning documents. Some attorneys will literally you could take pictures if it's artwork, put that in the will, tell those folks who it's going to. Okay, so definitely for this, again, seek an attorney. Let me get ahead to tax considerations right now. Taxes, and this is where a financial advisor and a CPA can come in and help, but taxes can absolutely significantly reduce the amount of wealth passed on to your heirs, okay? There can be planning done that can minimize the taxes alone. So there are cases that I'm not even sure I can get away with talking about this without being non-compliant, and this is no guarantee, but by just simply moving certain things, folks can save $10,000, $50,000, $100,000, millions of dollars by getting the right accounts and the right things into the right tax category. And I'm going to cover that in a different episode. But one of the things that we get asked a lot about is using the annual gift tax exclusion to transfer money. Okay, so if you're trying to gift money, there is an annual gift tax exclusion that you can give folks money without having to claim it on your taxes, okay? And again, I'm going to go over this in another episode, because I have seen a lot of folks asking on social media, how much can I give without paying taxes? Or some form of that question. And many of you think that, like, how much can I give my son or my grandkids without claiming it? And most of the responses that I see on social media they're just incorrect, or at least very confusing. And as a reminder and disclaimer here, I would not take financial advice via social media through a direct message, guys, or people just posting what they think. Even if they think they are taking screenshots from the IRS website or other websites, because I just saw this, sending screenshots, and it didn't even apply to what the person was asking, but there's no way they would know. So seek advice of folks that actually do this for a living, okay? Another thing about the estate planning tax exemption, as of right now, most folks are not going to be affected, okay? And the reason we're not going to be affected by an estate tax itself is because the exclusion, not annual, the exclusion is $14 million per individual, or $28 million per couple. So if you're married and you have less than $28 million, there probably won't be federal estate taxes. Your state may be different, but there are no federal estate taxes. If your estate exceeds this, that is when we get into more complicated trust planning and insurances, and how are we going to pay those taxes? So just think, if you have a $100 million estate and the exemption is $28 million, and you might owe 40% in taxes on everything above $28 million. That is $72 million you owe 40% taxes on. There are ways to alleviate that for those folks that this would affect, okay? And another thing is charitable giving. We can donate to charity to reduce taxable estates while supporting the causes that you care about, right? And last thing I'm going to mention on taxes, this is, again, another episode in itself. Let's talk about the difference between leaving behind an IRA versus after-tax money for your beneficiaries, okay? A lot of you listening to this have large IRA accounts or pre-tax accounts. A lot of baby boomers, we know this, have 401k balances. That's just what we saved into. And those are pre-tax, right? So if you take that 401k and you move it to an IRA, or an IRA itself is pre-tax, this just means that your heirs will owe taxes on withdrawals based on their income, okay? Maybe in retirement, you're in a lower tax bracket. Maybe it makes sense to do conversions now in your tax bracket rather than passing it on to your children or grandchildren, and they may be very successful. Run into that all the time, okay? We don't want to push your kids into a higher tax bracket because we didn't plan properly based on the accounts that we're leaving them, okay? On the other side of it, after-tax money, like funds in a brokerage account or a Roth, those are not going to be taxed as heavily. A brokerage account, which is where most of our money is, when we see very wealthy folks, we don't typically see it in retirement accounts. We see it in after-tax investments in a portfolio. If somebody passes away and they've put in $1 million and it's gone up to $2 million, when that person passes away, the person inheriting it, they step up to that $2 million. There are typically no taxes, and now their new basis is $2 million. Okay, so we can plan for that. It's called stepped up cost basis, and we can minimize the taxes when these assets are sold. Okay, so our action item here is work with your advisor or an advisor and an estate attorney to make sure our tax stuff is lined up properly and tailored to your estate. Okay. We're going to wrap up soon. Life changes. I want to talk about this. Marriage, divorce, birth of a child, a significant financial event that can affect your estate plan. We need to review what we are doing. Okay. We can't forget about powers of attorney, healthcare proxies. You guys know this. These documents allow individuals to make financial and medical decisions on your behalf. Okay. The action item that I recommend here is this, and I think this is very powerful. Our clients and the folks that we've implemented this with love it. Put an entry in your calendar right now. Okay. Let's just pick July 1st. I like July 1st, summertime. Make it recurring. And this is all it says. So in your calendar, I'm picturing my Outlook calendar in my head, recurring appointment, July 1st. All it says, do I need to update my estate plan? That's it. In the notes, I just want you to put the attorney and the financial advisor's email address. Every year when this pops up, you can either just ignore it if nothing has happened, or very easily send an email that says, Happy July, I need to make some updates. Get back to me when you can. That's it. Your attorney and your financial advisor can take care of the rest. That is the smallest, easiest step because as an advisor, it gets old seeing how many of these things are outdated and things get screwed up and it costs people so much money. Just put it in your calendar. Update it, okay? Make it simple. Let's take out the barriers. So last part, a lot of people, the reason they don't do this stuff, how long does this take? It sounds like a lot, and it is, but in most cases, if you're willing to spend a total of 5 to 10 hours, that's it. This should all be taken care of, okay? I usually get how much does it cost after that, so how long does it take and how long does it cost? The cost does depend on how complicated the situation is, but for a simple will, trust, healthcare proxy, power of attorney, you're looking at probably $1,000 to $3,000 and 5 to 10 hours. It will save so many headaches in the future, guys. So, and we've all heard this before, that 5 to 10 hours, people spend more time planning their vacation every year than they do their estate plan. 5 to 10 hours. That's it. Okay. Time to prioritize this. So as we wrap up, quick recap. Here's the to-do list. Email an attorney or us if you need to. Take the next smallest step and let's get rid of that nagging doubt about the updating or changing your plan. Number 2, review or create your will and consider whether a trust is right for you, okay? Number 3, check the beneficiaries. Check the designations to ensure they align with the plan. Make sure they're updated. We don't need to be leaving ex-spouse's money, right? Unless you want to. Number 4, decide on how to handle personal belongings and how to communicate that to your family. Number 5, take care of the bank accounts. What designation do we need on every one of those bank accounts to make sure it goes efficiently? All you have to do is walk into the bank and take care of it if you don't want to meet with an attorney. Number 6, consult with an estate attorney and an advisor to optimize the plan, okay? Hope that makes sense. I hope this is helpful. I hope it brought you guys value. There it is, folks. Estate Planning 101. Reach out with any questions. Make it a great day.
Thank you for listening to the Great Wealth Transfer Podcast. If this podcast resonates with you, reach out to 6 Point Financial Partners at 585-485-6048 or email dpulcini at 6pointfp.com.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. All investing involves risk, including loss of principal. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. Information here is provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither 6 Point Financial Partners, Private Client Services, nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of 6 Point Financial Partners. They do not necessarily represent those of Private Client Services, RFG Advisory, their employees, or their clients. This commentary should not be regarded as a description of advisory services provided by 6 Point Financial Partners or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives through Private Client Services. Member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory LLC, RFG Advisory, or RFG. A registered investment advisor. Private Client Services, 6 Point Financial Partners, and RFG Advisory Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.